Chapter 14 starts on page 217 of your textbook and focuses on income statements and budgets. We're going to talk a little bit about all of the different financial statements, the 3 financial statements that we prepare as part of accounting and business, but we're really going to focus on the income statement as the main source of our information for this chapter. So the income statement takes all of the different profit and loss centers that we've talked about throughout this course, sales and food cost, labor cost, beverage cost, miscellaneous costs, all the different things that we've learned how to control, and we're going to put them on one snapshot of how this business is looking. So the income statement is through a period of time, usually through an accounting period, and it tells us exactly where we're spending money, what the cash flow is looking like in our organization, where the money's going, what percentage of that money is actually going to different cost centers, and then tells us how we're operating at a profit. So the income statements help the managers to understand which parts of the business need to be adjusted, and it also helps to provide for a budget as we move forward, comparing the standard cost to the actual costs and create that the budget, which turns into our roadmap for all of our managers to follow. So this lets us know what a reasonable food cost is based on what we've spent historically. So the objectives of this chapter are to be able to interpret the income statement and interpret the budget, to read and create those things, to complete the information on the income statement, both in the terms of dollars and in percentages, to analyze the income statement and the budget variances, okay, our percentage and dollar variances, using the common size analysis and the comparative analysis, which we're going to get into a little bit later. And highlight potential problems, and then to create budgets based on our historical data coming from past financial statements. Okay, this particular book and the way that we're going to be learning income statements is not the standard uniform system of accounts by the National Restaurant Association. The uniform system of accounts for restaurants has a standard format that we use to create income statements, and it's very similar to this one. And by learning this one first, which is going to be a little bit simpler, it's going to help you get into that National Restaurant Association system so that we're able to compare data between businesses. Okay, so again, this one is a little bit simpler, easier to learn, makes that transition easier once we start learning the NRA approach. Okay, 3 types of financial reports, either whether it's a restaurant or any other kind of business. You have 3 reports that come out periodically. The first one, the balance sheet. The balance sheet has assets, liabilities, and owner's equity. Okay, remember that balance accounting equation, basic accounting equation, assets equals liability plus owner's equity. So on the balance sheet, we see all of the assets listed out, we see all of the liabilities listed out, and then we have the owner's equity there. And the balance sheet is really a snapshot of that business, how it's doing in one period of time. Okay, so it's a balance sheet for a specific day. Statement of cash flows tells us how the cash is moving from the business, so we can kind of have a broader perspective, where the money's going, what's available on hand, how much debt, how much investment we've got going on. All of this is in the statement of cash flows. And then the income statement is the overview of the business's revenues, expenses, and profit. So where exactly are we spending that money? This is an overview for a period of time. So it can be an income statement for the month, an income statement for the quarter, or a yearly income statement. But it tells us how much revenue we've made, how many sales, what our expenses are, then we break those down into dollars and percentages, and then how much profit we have. So we've got gross profit, we've got profit before tax, profit after tax, and we're going to go through each one of those. So if we look on page 219 of your textbook, you're going to see an example income statement. We're going to follow along with this one a little bit, but I really want you guys to look at this on page 219 and see how the whole thing comes together. We start out here at the top. It tells us what the period of this income statement is. So 1/1/11 to 12/31/11. So this is a yearly income statement. You can also have monthly income statements, weekly income statements in very, very large establishments, or you can do quarterly, different periodic income statements. But this one tells us it's for the year. starts out with the sales here at the top and then breaks it down between food and beverage sales, adds those two together for total sales. The next one is the cost of sales, and we're going to go over each of these specifically, but I want you to see how they all go together on this statement. So the cost of sales, food and beverage cost, total cost of goods sold is those two put together, the food cost and the beverage cost. Then we come up with a gross profit. Then we come down here to our labor. Prime cost, of course, is our cost of goods sold plus our labor cost. Controllable expenses then come next, all the different expenses that we can control as managers. Okay, add those up. Income before fixed costs. Okay, that's before we get our fixed cost, occupancy, interest, depreciation, and then down here at the bottom, profit before taxes and net income. As we look at this through the presentation, we're only going to see little snapshots of this, but it's very important that we see that all the snapshots go together to create one document that's called the income statement. Okay, so the income statement format we just talked about can be written to cover any time period. This one, of course, is for a year. It can be written weekly, monthly, quarterly, annually. I mean, you can have an income statement for multiple years if you wanted to, if it would do you any good. But it doesn't have to just be an annual document. It can be for any time period. Common size income statement, that's what we're going to be talking about here. That's what the example is on page 219. It lists dollars in the first column, and then the second column it has percentages for each line item and each category. So as we're coming down through this, we see the percentage of food revenue, for example, on page 219 is 74%. That's percent of sales. So we always need to look at that total sales. We need to add that up first, and that becomes our percentage. So if you look down on the line that says total sales, $982,755, it has that 100% next to it. That's where all of our percentages are coming out of. So of our sales, 74% were food and 26% were beverage. The only things that do not fall into this category are food cost and beverage cost. Okay, these come out of the food and beverage sales specifically. Okay, they don't come out of total sales. Okay, so the percent is each one. Percent of sales except the subheadings under cost of sales. So here is your first question for this chapter. Which are the only two line items of an income statement that do not come out of sales to determine their percentages? Okay, the answer to that is food cost and beverage cost because they come out of their respective categories. They don't come out of total sales. Okay, so figure 14A, we're getting away from this little income statement, or the income statement on page 219, and we're going to go to a different one. Okay, it fits exactly the same way though. So we have our total sales at $375,400, which is 100%. So when we start pulling out percentages for each thing, our salaries and wages, 29.4%. And we're going to round this to one decimal place. Employee benefits are 6.6% of sales. So our total labor cost with our salaries, wages, and employee benefits are 36.0 or 36% of sales. Okay, so we always want to start with that sales category. The first thing we need to know when we're creating an income statement is how much income we have. Okay, so once we have our sales category, then we're going to subdivide that into what brings our sales in. If we're a restaurant, it's probably going to be food and beverage sales. If we're a hotel, we're going to have room sales, but we may also have food and beverage sales as well. So it really depends what kind of establishment we have as far as subheadings. The examples in this book are going to be strictly restaurant examples, so we only have two different sales generators or profit centers, and that's food and beverage. But know that no matter what your facility is doing, you could have catering sales, you could have room rental sales, you could have all different ways to get that profit and get that revenue coming in other than food and beverage. But for this example, we're going to stick with food and beverage as the only thing that are bringing money into our establishment. Okay, so percents for food and beverage sales show the sales mix between food and beverage. So in the first example on page 219, we see that we have 74% food and 26% beverage. So obviously we sell considerably more food than we sell beverages. If this was a bar, they may be switched. We may have 74% beverages and 26% food. But it's going to show the relationship to what brings the money into the establishment. So total sales always equals 100%. That's all the money that's coming in. So the subcategories, the cost of sales, this is the only one that uses different percent base. So we're not basing this on the total sales, we're basing it on their subcategories. So our food cost percent, for example, is the food cost divided by the food sales. We don't want to divide that by total sales because we've also got beverage costs in there. Okay, so the beverage cost is also separated out. The beverage cost percentage is the beverage cost divided by the beverage sales. So for each category that we have, each subcategory, to find the percent of that category, we have to make sure that we're not dividing by total sales, we're dividing by that category's sales, whether it's food, beverage, catering, room rental, whatever it is, it's going to be divided by that category. Everything else that we see is going to be divided by total sales to get a percentage. Okay, so the total cost of goods sold are all of the food and beverage costs. Now these are variable costs. We've talked about the difference between fixed and variable costs. Obviously we can control the costs of food and beverage by having good recipe costing procedures, by having good purchasing procedures, all the different things that we've talked about throughout this entire course. We can vary the cost of food and beverage sold as much as we can. Okay, we can control those costs a little bit. But these are variable costs, and it's the sum of the food and the beverage costs together gives us that line item on our income statement of the total cost of goods sold. Okay, gross profit is all the money left from sales after our cost of goods sold is deducted. Okay, this is before we get to other variable costs, certainly other fixed costs. This is just money left after total cost of goods sold is deducted. So here we see it on the income statement. So our food and beverage, we see 74 and 26%, but our cost of sales, so our food cost, we take that $225,180, we don't divide that by the $982,755 because we're taking that out of the food portion. So we take the 225,180, divide it by 727,194, and we get 31% food cost. Okay, certainly we need to take that, that's our actual food cost, and compare it to our standard food cost. We'll talk about that a little later in budgeting. So the beverage cost, same thing. We take the $58,804, divide that by 255,561, or the total beverage sales, to come up with a 23% beverage cost. So the total cost of goods sold, $283,984, is 28.9% of the total sales. Now we're going back. Everything now is coming out of total sales, not out of the food and beverage. The only two that come out of food and beverage are the food cost and the beverage cost percentages. Okay, so the gross profit we see $698,771 is 71.1% of total sales. Now this does not mean that our business is running a 71.1% profit. We still have a lot of expenses to take out of that. Okay, so some of the expenses, labor costs, certainly this is a variable expense. Okay, it's really a mixed expense. Some of it is fixed, some of it's variable, but our labor cost is all of our cost for our employees, including their benefits packages. So when we went back a few weeks ago when we were talking about benefits and how we get the labor cost is not the same as adding up all of their paychecks, because remember, we've got other things that we need to pull out. You know, things like FICA, which is your Social Security and Medicare, workers' compensation insurance, general liability, you know, all the different things, Elective benefits, health insurance, paid vacation, all of those things go into that benefit even though the employee doesn't see it financially. Okay, so it's a semi-variable cost, also known as a fixed cost, or a mixed cost rather, because it's a mixture of fixed and variable costs. So our salaried employees are fixed costs. We know what we're paying them. It's the same every single week, every single month. Our hourly employees are a variable cost because they're going to vary as the revenue increases and decreases. Okay, salaries and wages, we have the workers' income. Employee benefits, we've just talked about. These are all under that labor cost. And then, of course, the prime cost. So the prime cost, we should recognize this term from previous chapters, is the total cost of goods sold and the total labor cost. What did it cost to make that dish, including how much we had to pay somebody? Okay, it's how we do the prime cost for menu pricing. We do the same thing on the income statement, but the prime cost is everything together. How much did we spend to make our menus? How much did it cost us to serve all this food? Plus, how much did it cost to have somebody make it, serve it? You know, all of our labor, the purchasing agent, everybody in there together. Okay, so here's the labor section of the income statement. We see salaries and wages total at 28%, $275,442. Then we add on the benefits there for the total labor cost, okay, which is all the benefits included, of $327,597, which is 33% of revenue. So 33% of everything we bring in is going to labor cost. Now our prime cost, we take our total labor cost, add it to the total cost of goods sold, and we have $611,581, which is 62.2% of our revenue. Okay, controllable expenses are then coming out after that. So controllable expenses are all other types of mixed costs. Some of them are fixed, some of them are variable. But these are the things that we have control over, okay? Not things like our rent and things like that, but these are other expenses that we can control a little bit. Direct operating expenses are the cost for things that go toward serving the customers. So things that aren't food and drink, but things like flowers and decorations, parking services, cleaning and paper supplies, kitchen and bar licenses, all kinds of things that go toward serving customers, but not things that they specifically buy. Okay, so these are direct operating expenses. Music and entertainment, okay, definitely some things that we can control there. The licensing fees, royalties, performer fees, and food. How many of you guys know that even to play music in your restaurant, you have to pay licensing fees for the music? Lots of things go into this that we may not think about. Okay, equipment for the entertainment. This all goes into that music and entertainment cost center in our budget. Marketing. This is all of our marketing activities, all of our advertising, our PR campaigns, things that are even like sponsoring a Little League softball team. This all goes into that marketing. Okay, comp meals all go into marketing. Running different specials go into marketing. Utility costs, this is gas, water, electricity, waste removal, all the things that we have to pay for. Sometimes, depending on our jurisdictions, we have to pay for trash removal. We may have larger water bills because we're paying sewer for that. We may not. It really just kind of depends on where we are and in what geographical area, what the laws are in that area. Okay, general and administrative costs. This is the infrastructure, all of the things that it costs, office costs, if we want to think about it that way. Things we have to do business. We have to have a telephone line, maybe a fax machine, maybe a computer, POS system. Maybe we have to update licenses on that, office supplies, all the different administrative things that we use in our establishments. And then, of course, we need to have a repair and maintenance in there. Obviously, kitchen equipment does not last forever. We're always trying to repair or having to repair something. So we need to build that in to both our budget and have a line item on our income statement for that. So all equipment and facility repairs, all maintenance gets listed in that cost center. Okay, total controllable expenses, well, we add all of those up. Okay, add up every controllable expense we have. Then we get income before our fixed costs. Okay, so we have all of our revenue, we take out our cost of goods sold, and then we have our gross profit. Then we take out our prime cost from our revenue, and then we have income before controllable expenses. Then we have income before fixed cost. Okay, so that's going to be total sales minus our prime cost minus our controllable expenses. So everything that we've brought in, we're able to cover fixed costs and profits together. Okay, here's how it looks on the income statement. So all of our controllable expenses we're adding up. Our direct operating, music and marketing, or music and entertainment, marketing, utilities, administrative, repairs and maintenance. So 16.3% of all of our revenue, everything that comes in, is going toward these controllable expenses, or has in this whatever period that we are developing this income statement for. Okay, so in this case, it's a yearly income statement. So for the year, 16.3% of our revenue went toward our controllable expenses. So our income before fixed costs is 21.4%. Okay, so our fixed costs have three major categories. The first one is occupancy cost. Do we rent that building? Do we own it? Do we have a mortgage on the building? Do we have some type of lease? Do we have property taxes? Both property insurance and general liability insurance have to go into those. So these are costs that we've signed up for that don't change as time goes. All of the things that we need to occupy the space that we're in. Interest costs is the cost of taking out a loan, of using someone else's money. So we may have this from selling shares of stock. We may have this from taking out a business loan. But whatever our APR is on our business loan, we can calculate what those interest costs are going to be as we pay that money back. Depreciation is how we spread cost across equipment and facilities that are losing value over time. Obviously, we wouldn't pay the same for a 10-year-old oven that we would pay for a brand new oven. So that has to depreciate. And there are different ways that we can depreciate this, whether we use a variable depreciation or a straight line depreciation, something where we say we may have 10 years of usable life out of this product, and after that 10 years of usable life, we have to throw that away. We can't get any salvage value for that. So we would take the value of that product, divide it by 10, and 1/10 of that each year is counted as a depreciation expense. And there's a couple of different ways to do that, but that's the most common, is that straight line depreciation method. Okay, so our total fixed costs are all of our fixed costs together, all three of those major categories. Then we have profit before taxes. Taxes, of course, are a very big deal. As of right now, there's a 5% corporate tax in South Carolina, but we also have federal income taxes, federal corporate taxes that we have to pay. So lots of different tax brackets that can get a little bit complicated. But our income before fixed costs minus our total fixed costs gives us our profit before taxes. Okay, so the only thing we have to pay taxes on is this profit before taxes. All of those expenses we can deduct from our taxes. So we're not paying taxes on our total revenue. We're paying taxes on our income, or our profit rather, before taxes. Here's how that looks on the income statement. You can see all of our fixed costs here. So our total fixed costs are 16.2% of our revenue. So our profit before taxes at this point is only 5.2% of revenue. So $51,533 or $553 in profit. Then we have our income taxes. So depending on the tax brackets and the specific tax laws, they're going to vary a little bit, but this has 1.2% of our revenue being paid out in taxes. So our net income at this point, after we take out the taxes, is 4% or $39,340. Okay, here's how it looks on a graphic formula. So we've seen this graphic over and over as we're determining percentages and things, and it's used the same way. Whichever one we want to find, we cover up and we follow the directions for the rest of the graphic. So if we're looking for a cost, we take our sales times the percent that that cost represents. If we're looking for the percentage, we take the cost divide by the sales. Okay, if we're looking for the total sale or the sales, then we take the cost divided by the percent and it'll give us our total sales. So when it says sales there, it means total sales or total revenue. Okay, so an example of this, on an income statement, marketing is listed at $7,000. Total sales are $380,000. So what percentage is marketing? Okay, so our percentage is our cost divided by our sales. So in this case, $7,000 divided by the total sales of $380,000 gives us 1.8%. Okay, again, anytime we're working on these percentages, we're going to take them back down to one decimal place. So 1.8% is our marketing cost. Okay, an income statement lists food sales at $114,600. The manager wants to run a 30.4% food cost. What should food cost be in terms of dollars? So our food cost, going back to our graphic, is our food sales times the percentage of sales. So it's $114,600 times 0.304 or 30.4% gives us $34,838 in our food cost. Okay, the next part of this chapter is about creating a budget, using historical data from statements to move forward, and then going through a comparative analysis on these. So comparing statements and looking at different ways that we can make sure that we're controlling our expenses correctly.